Well, I'd like to welcome everyone today to this event, which is part of our Insight program, which aims to share practical lessons on private sector investment and development based on our experiences, knowledge, and research. I'm delighted today to be joined by Amit Bouri, CEO and co-founder of the Global Impact Investing Network. The start of this decade was heralded by global leaders as a pivotal moment for the UN's Sustainable Development Goals, the SDGs, which was intended to be the global blueprint for poverty eradication. And impact investing seemed to many to be a key vehicle to help address the estimated $2.5 trillion funding gap and drive the changes we needed to meet that 2030 SDG challenge. But then the pandemic struck. And today, we will have a conversation with Amit about the impact investing industry, about what he's seen in that industry, and also about COVID and the challenges it's made to the industry. Amit, it's wonderful to welcome you to the virtual CDC. And it's always great to get the opportunity to talk to you about GIIN and the great work that you're doing. Let me start out by taking you down memory lane to 2011, when JP Morgan published a report entitled Insight into the Impact Investment Market. You probably remember it because you, along with Yasemin, were the authors of that report. But I looked at it before our conversation today, and in it, there was a forecast that you and Yasemin thought that perhaps as much as $3.8 billion would be invested in impact investing in the coming year. I think, if I'm right, that in your most recent 2020 survey, you've estimated that impact investing is now worth $715 billion. And so my question to you is, when you look back on that, when you look back on those 10 years, I mean, does this surprise you that we are where we are today in impact investing?
Well, first of all, I just want to say thank you so much for this opportunity, and good morning, good evening, good afternoon to all of your guests who are here joining us for this discussion. I think when we first launched the GIIN and really kind of really try to promote this market for impact investing, our hope was that this would be something that all investors would participate in, and certainly we had very modest means back in the early days when the GIIN was launched in 2009. Actually, in September at the UN General Assembly week, we had just over 20 members, and it was a great success. We were thrilled to have 20 members. Now our network includes over 330 organizations in 50 countries, and I think both that sense of the size of the network, but also the scale of the market are real signs for the true potential for impact investing. So that current estimate at $715 billion in global assets under management reflects our best estimate of how big the market is today. But I think you really anchor this discussion on an important point. We are kicking off the decade of action for the Sustainable Development Goals, and we know that impact investing will have to grow dramatically to rise to the occasion that the world's leaders have set for us in these important ambitions in the SDGs. And so we are very focused on how we drive that continued growth and really sustain the integrity of impact as the market evolves.
Yeah, and Amit, what do you think has driven this growth? I mean, back in 2011, you and others had a lot of interesting hypotheses, but as you look back, what do you think has charged impact investing today?
Well, I think a couple things. Some are kind of in what's happening within the market, and some are about the external environment that we're operating in. Starting with the external environment, I think that there's a growing recognition that if we do want a world that's sustainable, just, and inclusive, we have to invest differently. And what seemed like a fairly radical idea in our early days, this notion of putting money to work to have a positive impact on the issues like those identified in the Sustainable Development Goals, seemed like it was something that was just unfeasible, or something that was the realm of governments and philanthropists, but not serious investing. What we have now is a recognition that with the issues like climate change and inequality continuing to unfortunately advance around the world, even pre-COVID, there's a recognition that investors and businesses need to operate differently. Now, within the impact investing market, in parallel, we've seen a significant growth and sophistication and track record for impact investing overall. So we have more data, we have a strong performance record across the market, and we have increasing tools and resources that help build the credibility of impact investing. Now, these two things, the internal and the external, are converging at a moment when the world really needs that to happen. And we're now seeing a lot of mainstream interest in impact investing all around the world on 6 continents.
Yeah, and I'm curious, what has attracted you to impact investing, and what kind of drives you? I mean, you founded GIIN in 2009, as you said. That's a long run in today's today's market. So, what keeps this kind of interest going on a personal level?
Well, thanks for asking. And for me, it's in part just about my personal history, and also part of just intellectually what I think needs to happen and where I want to apply myself. On the personal front, I was actually raised by a single mom since the age of 3. We actually spent about 6 years in my early childhood on what we call in the U.S. welfare or public assistance, which really just was a result of my mom going to school to be employable in the U.S. She was an Indian immigrant, and her credentials didn't transfer over to the U.S. employment environment. And so that really grounded me, growing up low income for a good part of my formative years, in a strong sense of purpose, and just a recognition of the broader human experience. And I've also really benefited from some of the most amazing educational opportunities I could ask for. And so that recognition and that just personal experience with social and economic mobility has been very powerful for me. It's something that I want to make more available to everyone around the world. And then the intellectual side of it is a recognition that as important as philanthropy and government action are, we also need the private sector to operate differently to create more opportunity and prosperity for all the world's people, not just the fortunate few. And so that combination of my own personal history, as well as my understanding of the best way to apply my skills, has led me to have the longest job I've ever had at the GIIN, and it is something that I continue to be incredibly inspired by the work that my organization does, but also more importantly, what our global network of over 30,000 people are doing every single day to make the world a better place.
Well, that background certainly has made you a great champion for the industry.
Oh, thank you.
Back in 2010, back in 2011, when we talked about impact investing, it was really a creature of the developed world. But over time, the focus, especially for CDC, has kind of come on the more developing world. And I wonder if you have an insight in that shift, and when that pivot or when that additional focus happened. When did impact investing become sort of important in the economies of low and middle income countries?
Yeah, I think what impact investing represents, and it's important to underscore the fact that the term was really coined around 2008 and really came into prominence over the coming years. When the GIIN was launched, no one in the world was talking about impact investing. But what they were talking about, which we define as, we include in the term impact investing, are things like social investment in the UK, community development in the United States, development finance, in lower and middle income countries, things like microfinance and others. And impact investing really created a term and a brand and a unifier to bring this higher level concept of impact into investing that could be applied anywhere around the world. What we've seen is a growing recognition that there's opportunity for impact investing all over the world, and that's one of the things that's most exciting. I will say that there are certain emerging markets that were really critically important in the development of the global impact investing market, including at least 2 that are very important to the CDC. One is in South Asia. India has really been a pioneer in developing a very robust impact investing ecosystem. And also in East Africa, particularly around Kenya, We've seen a thriving community of entrepreneurs and investors and other types of intermediaries and capacity builders that have really helped contribute to why I think are markets that are leading the way in the global impact investing community.
So GIIN has, done quite a bit over the years for the impact investing community, but it's really become known for setting up these frameworks, and especially impact frameworks. And I wonder if you could tell us a little bit about where GIIN is on that, and a snapshot of the future. I've heard a bit about some of the harmonizing initiatives that GIIN has been championing.
Yeah, and this is critically important because I think one thing that all investors are wired to do is to understand financial performance and risk. We're obviously trying to change the way that investors think about the role of their capital and their purpose, so that they see impact just inherent to investing, and it becomes part of the status quo, the new normal for the way we think about capital and investing overall. What's important to accomplish that, though, is we need to have the same degree of sophistication around impact measurement, management, and performance as we do around financial measurements, management, and performance. And we have been working very hard with partners like the CDC to really help advance the sophistication of what we would call impact measurement and management. We're at an incredibly exciting time, though, when it comes to that work. We're part of a partnership with the European DFI network, as well as with the International Finance Corporation and a number of the private investors in our community to drive more harmonization around the way in which we define and measure impact. Our big contribution to the market around this is called IRIS Plus. It builds upon a decade of experience, and IRIS Plus is a comprehensive system for measuring and managing impact. It's built around the SDGs. As you well know, Colin, you're very instrumental in the work we did around gender equity, and that we've synced that up with the 2X challenge that the CDC and others have been involved in leading. IRIS Plus is a free online resource that allows investors to start with an SDG, identify the right investment strategies to help support that SDG, and then have these specific metrics that have been vetted by a broad set of stakeholders and backed up by evidence that will allow them to track and monitor their performance, ultimately to make them more effective impact investors. What's exciting about the moment that we're in when it comes to that work and that harmonization that's so critical is that we are seeing tremendous strides in getting the entire global market to start speaking the same language. In just over a year since we launched IRIS Plus, it has over 11,000 users around the globe and growing. And we're now seeing the world's major institutional investors and global financial institutions express interest in understanding how they can measure their progress towards impact goals. And that is incredibly powerful because if we are going to close that gap for the SDGs, we have to mobilize those huge pools of private investment capital.
So I think we've put it off as long as possible, but I think we're going to have to start talking about COVID.
Yes.
And COVID has been trumpeted by some as changing everything. But in the impact investing world, has it changed anything?
It's a really important question, and I think one thing just to state what may be obvious, but I think it's really important to level set on this is that the COVID crisis is actually a series of crises in my view. It is of course a crisis that is about public health, but is also an economic crisis, and I believe it's also led to a crisis of trust and confidence in the system. In institutions like government and the private sector and even NGOs and the media in being able to respond to a global threat. What I think is so important is that the world is thinking about this across a number of stages, and at least that's the GIIN strategy of how we think about addressing the COVID crisis, both in the upfront response where most of the world is focused right now, but also through the recovery. But how do we build a system on the other side of this crisis that is actually more resilient? And so how do we actually remedy some of the flaws that have been exposed by this crisis? A firm like CDC will know that many of the inequities that have been spotlighted by the COVID crisis are not new. They're exacerbated by the crisis, but they've existed for a long time. Inequities around poverty and socioeconomic status, around gender, around race and diversity. But those are now being highlighted in a way that is incredibly visceral for the entire world to see. And I think it's really critically important, that impact investors, who have honed this discipline over a decade plus of putting money to work to drive positive outcomes for stakeholders, are front and center when we think about the recovery. I think we have a really critical role to play in helping to drive a recovery that results in real impact for people on the planet in a way that helps us build back into a better system than the one that was hit by this crisis in the first place.
At last year's GIIN annual conference, there was a lot of talk about the SDGs and about closing this $2.5 trillion gap in funding. Do you think COVID has inhibited the ability of us to close that gap, or do you think potentially it's even aided us in closing that gap?
Well, I think that it's, this is an important time for the SDGs. We're coming up in a couple of weeks on the 5-year anniversary, of the announcement of the SDGs. And I think this was an important time to take stock for our progress and the way we, how far we need to go to actually achieve these important goals. I worry that COVID has really captured the attention for understandable reasons and has kind of taken the eye off the ball for the SDGs. So I think this is an important time for the United Nations and for all the leaders around the world committed to the SDGs to really make sure they are seen as front and center as part of the COVID recovery. But I do worry that along many dimensions, we've seen the world take a step back as opposed to a step forward. That there's been incredible damage to lower income communities. Of course, the CDC is well aware of some of the flight of capital from some lower income countries, and a crisis like COVID brings everyone's time horizon shorter, and closer. It becomes shorter in terms of the more immediate needs as opposed to the long game. It also becomes more closer to home, where there's a lot more focus on how do we address issues in our communities and in our in our own countries domestically. So it's important for us to make sure that we lean into the things that were so inherent to the COVID crisis around our interconnectedness and our interdependence, because I think that will be critical to shaping our recovery. That really does make sure that we take the lessons learned from this crisis and apply them to make sure we address these critical issues like inequality and the climate crisis that are really embedded in the SDGs.
So a key part of that 2011 report that I mentioned was how practical it was. So let me finish off with this question. What are the practical advice, or what are the practical steps that you think we can take now in order to expand the impact investing market further?
Well, I think one of the things that's so important for us, and I think a good opportunity for impact investing, is that I mentioned that overall crisis of distrust and confidence that we're experiencing around the world, and that was actually building pre-COVID, but I think COVID has exacerbated that. But what impact investing is fundamentally about is putting money to work to have a positive impact for people, for communities, and for the planet in a tangible and measurable way. It's focused on driving real results. And I think that emphasis is absolutely critical when we think about the recovery from this crisis, that we as impact investors and folks who are focused on development finance really underscore what we have to offer and lean into kind of advancing the market so it will actually be able to channel all those huge sums of capital from institutional investors to the communities that need the most. So a few things I'd highlight. We need to continue to work to educate investors about the possibility of impact investing, but also to bring a broader social mandate. So ordinary pensioners, whether they're in the UK, in the US, or anywhere else, ask that their money is put to work to have a positive impact on the world. We also need to make the case to the CIOs of the world, but we actually are now seeing a lot of interest from that community. But I think sticking to basics, making sure we have We adopt measurement tools like Iris Plus. We work to help make them better. And we really help share the data and do the research to make the case to the world broadly that we have to invest differently if we do want a sustainable and inclusive world.
So thanks, Amit. Let me now broaden out the discussion and invite in Yasemin Lamy, who is the Deputy Chief Investment Officer of CDC on Catalyst Strategies, in addition to being one of your co-authors in that 2011 report that I made reference to. So do we have Yasemin?
I'm here, Colin.
Fantastic. Yasemin, I'm just going to dive right in, I'm afraid, on COVID with you. I know that you've been driving CDC's response to COVID, investment response to COVID. Can you tell us a little bit about what CDC has been seeing and what they've been trying to do in this COVID crisis?
Yes, absolutely, Colin. I'm very happy to do that. And it's a pleasure to be here, especially with you, Amit. Thanks for coming along today. I thought I would start with a little personal story and take us back to March. So, I think there was quite a sudden change, obviously, in all of our lives when our cities went into lockdown. And for me personally, I was sick at the beginning, and I felt crushed by what I was watching happen around us. And I was so energized by these little bubbles of energy all across CDC. I could see my colleagues, and this is what's incredible about working in impact investing. I could see my colleagues just popping up and saying, we need to do this to save this portfolio company, or there's an opportunity over here. We can actually help grow a company that could serve at a time of need. And so I actually called my boss and said, from a personal standpoint, for me to survive this right now, I need to be productive and I need to actually feel like I'm doing something. And here we have this tool. The Catalyst Strategies was defined to take higher risk for pioneering impact. Isn't that exactly what we need to be doing right now? And so we put together quite an organic shape to our COVID response that was kind of built off of where the energy lie. So the first pillar we called it the preserve pillar, and it was all about safeguarding impact in the existing portfolio and helping those companies weather the crisis. The second pillar was called strengthen, and it was in recognition that we would have companies in our portfolio that could actually step up. Big Basket is a great example. It's an online grocery delivery service in India. And we all know about everything shifted into online delivery service. And so they scaled up dramatically. They had to recruit something like 7,000 new staff. And we've been working with them to help make sure, both with capital and also with advice and guidance, to make sure that they could do that in a way that protected their staff and served the need. And then the third pillar is one we named Rebuild, which is all about that long-term recovery, maintaining our role as a long-term partner investing in the markets that we work. I'm really pleased to say that from a capital perspective, the preserve pillar, we ended up deploying less than we thought we would need to, which I think hopefully speaks to some resilience in the portfolio. I will say there was and continues to be intensive portfolio management going on. And we still have a lot to learn about how this crisis will continue to unfold. So that is something we are maintaining a lot of vigilance around. And on strengthen, we set ourselves a target to try and deploy about $500 million. And we are on track towards that. We have approved $435 million so far. And then we also, one of our subsidiary companies, MedAccess, which specializes in volume guarantees in the pharmaceutical space, made a $50 million commitment with UNICEF to guarantee some of their product distribution into lower and middle income countries. So we're really pleased with what we've been able to do so far and hope that we'll see the impact come off the back of that commitment.
So Amit, I mean, you're sitting in New York City, and I think both you and Yasemin have made reference to this capital flight. Do you think, I mean, what you're seeing, that the economic impact of COVID is going to continue to inhibit investors in our markets, these lower and middle income countries?
Well, I think it's, what's important to highlight is just the nature of kind of time and how this will evolve. And of course, we don't know what's going to happen in the future. But I think in the immediate response, I think there was kind of a circling of the wagons, if you will. Everyone was just trying to make sure that their portfolios were safe and initially much more conservative around how they thought about investing. And I think it's for understandable reasons. There's a lot of financial volatility. The place like New York was hit incredibly hard by this crisis. And so you see people really focused on the here and now and making sure that they are really focused on kind of the basics of protecting their portfolio, supporting companies that they're involved with. But I think that we're now in a phase where people's sights are being lifted a little bit and looking a bit more broadly. We did do some research on the early days of the pandemic and found when we asked impact investors about their plans for their portfolios and for their investment plans for the year, the majority of them said they were actually planning on maintaining their capital commitments or increasing them as a result of the crisis. There were some that were also planning on pulling back, but it was that the balance was tipped in the favor of sustained or increased activity. I think what one couple things to underscore is that investors will still want global diversification. They'll still be looking for new opportunities. But I think you asked about kind of tangible things around what needs to get done. Some of the issues that we're now facing are not just around conceptual barriers or intents, but actually around the mechanics of investing. We had a number. We also surveyed investors and found that there is not that much of a challenge getting new pipeline for deals. There's a lot of great opportunities for them to make impact investments. But actually conducting due diligence in this environment where we're so physically constrained has been immensely challenging. And so many of our members are learning to adapt, trying to collaborate differently, how to share due diligence, share information, figure out new ways of connecting and establishing policies that allow them to make new commitments and surface new deals. But the world is still adapting to this new environment.
So Yasemin, I mean, with capital and investors fleeing these markets, in our geographies, you don't have many government protections. I mean, your phone must have been ringing off the hook as one of the few sources of capital. I mean, how did you decide which calls to take?
It's a great question. So we were triaging on the basis of a couple of parameters. Well, first I would say we defined our impact priorities right up front, and it was actually such a helpful tool. So that was, for us, that was a moment where we said, okay, we have our set of capital, we have our set of resources, as in people's time as well. And this is how we want to prioritize across impact. And really at the top was, it was a hierarchy of needs. So at the top of the list was essentially human survival, healthcare and food security and water and sanitation. And then the next set of priorities was all about the enabling environment. So energy access and financial services as kind of the engines of society. And then kind of sadly at the bottom of the list was internet communications, education, which are very important sectors, but kind of that was the way we set out the priorities at the time. We would triage on the basis of whether the partners coming to us were keen to step up. Some came to us and basically offered that we take the risk off their books, and that was not of interest to us. We were looking for partners where we would step up together and would side by side step in and take new risk. So that was one. And then secondly, we also recognized that we would have to, when we mapped out kind of the set of needs, there was a recognition that there were some kind of more generalist market level needs, and then there would be targeted populations that would need more targeted solutions. And we also recognized that there would be a balance between kind of scalable solutions that we could get quickly out into the market and the more targeted solutions that would take more kind of multi-stakeholder engagement and specialist fund structures, and probably be slower to deploy as well. And so we kind of said, let's make sure that we have a balance across those two types of interventions, and that we're working with partners that are really about stepping up at a time of need, not stepping back.
And you mentioned in your introductory remarks that this catalyst strategy, this CDC catalyst strategy, is to make higher risk investments. I'm wondering, in light of COVID, has that universe grown? So you have, more of the world is now available to you, or has it changed your approach or strategy in any way?
It was really important to me that we didn't just throw everything into the catalyst bucket. We did a lot of work to define carefully what risk we want to take with catalyst. And so actually we started off thinking, should our COVID response be a catalyst strategy in and of itself? And quickly realized, actually, we have a whole suite of tools and all of them should be deployed for this purpose. And so we actually have a growth set of investments, a catalyst set of investments, and then we also used our technical assistance facility, CDC Plus. And I would describe the risks that we are facing. I mean, we have the usual risks that we always analyze: investment risk, environmental and social risk, business integrity risk. There was also a question I saw about the role of private sector, public sector. Those started to blend, especially in the healthcare space. So those still were there. They were obviously heightened. In addition, I think we were also faced with having to balance instrument risk, the risk of the relationship you have with the promoter or the fund manager or the sponsor of the investment, and the market risk. And so if we kind of think about March timeframe and today's timeframe, I would say in March, we didn't have any visibility on the market risk. We had existing relationships that we could leverage, and we could kind of work with an instrument that was more comfortable for us, which was debt, where you could have shorter tenors and you had a fixed kind of life to the instrument. And so putting our investment focus on debt and with existing relationships, we could weather the increased risk of the market. Today, I think we have more visibility on the market risk. And so we've said, okay, we can return to using debt and equity, and we can also start to consider building new partnerships. That means that we need to get comfortable with the remote due diligence capacity that we have today, leveraging a lot of our partners in market, including CDC staff, SCDO staff, and others that can help us get there.
So let me go back to Amit. I mean, Amit, do you think there's anything in the experience that you and Yasemin have had in impact investing that more traditional financial institutions can take in this kind of response to COVID?
Well, I think one of the people often talk about COVID accelerating trends that were already kind of in motion. Things like remote work and others have now. Some people say it's moved ahead a decade, compared to the natural progression that was already underway. I think one of those things that's being accelerated is actually interest in impact investing from mainstream institutions. Yasemin and I started working together. Actually, she helped kind of create the research capacity at the GIIN through our partnership when she worked at JP Morgan. Along with your other colleague, Nick O'Donohoe, who was very involved in the GIIN's founding. So there were big institutions like JP Morgan interested in impact investing even back then, a decade plus ago. But now we see it very commonplace as, just about every major global bank has some activity in impact investing. And increasingly major institutional investors, so pension funds, insurance companies, and others are coming out to us to ask about impact investing and see how they can become more active. In putting money to work to drive positive outcomes, particularly for the SDGs. And these are not just American or Canadian firms, they're from the UK, from other parts of Europe and Australia and even Japan. So we're seeing a very interesting groundswell of interest from mainstream institutions. I think what's important, and just to build on something that Yasemin said that you've been doing within CDC, that I think is really important for us to do at a market level, is really be clear about what are the risk return profiles of different opportunities in impact investing. Just like you've had to manage that with the Catalyst fund relative to the other elements of your portfolio. A big pension fund is when they write big checks, they tend to be fairly conservative because they have a huge obligation to pensioners to pay them back in 30 years, which is very different for members that we have that are venture capitalists, who love risk and they love assessing it, and they're into things that have immense, extraordinary outcomes and potential, and that's an ecosystem that moves capital to high impact opportunities. needs investors along that entire continuum. And that's part of the work of the GIIN and our network, is to help organize the overall market in a way that allows bigger institutions to play their role in closing that financing gap you started off with in your opening remarks, calling around the SDGs and meeting those important global goals.
Great. Let me bring it more general again. And Yasemin, I'm going to give you the opportunity to reconsider that 2011 report that you wrote. Today, what do you think is holding commercial investors back from impact investment? I mean, 700 billion is a very large number, but 3.5 trillion is certainly a much larger number by comparison.
Yes, Colin, I think there is a big learning, and actually this crisis has taught me a lot about balancing innovation with tried and tested tools. So if you look at the evolution of the impact investment market, outside of probably community finance in the United States, the bulk of the work has been really focused on the private equity instruments and maybe some venture capital funds, but really fund structures and usually equity investments. And I think that's quite limiting, especially for an institutional investor who, as Amit says, has more commercial return hurdles and thresholds that they need to operate within, but also from a scale perspective. So often what's holding them back, and I lived this at JP Morgan, was, we had a certain ticket size that we needed to meet, and the opportunity set was much smaller than that. And so there was a disconnect between the kind of business as usual size of things and scale of things that we were doing and what the impact investment opportunity set looked like. And actually, I think using credit and partnerships with banks, and I would just speak to, the trade finance partnerships that we used as part of our systemic liquidity response back in May. It's a bilateral partnership between CDC and a bank. The bank is making loans into the market. We share the risk with the bank. It's actually fairly straightforward. And actually, we did a lot in trade finance, which is a very low risk instrument. And we published an article last week with a colleague, Diana Kohler from the trade finance team, about how with historic default rates less than 1%, this is a huge opportunity for investors that want to step into an impact investing domain. But today there really aren't a lot of impact investors in this space. And I think part of the reason is it's pretty old fashioned. It's kind of a boring instrument from a long time ago, and it's easy to forget about tried and tested tools when we're all looking forward to the future. So I think there's some opportunity to work more with debt and work more with banking partners and not just with fund managers.
Yeah. Colin, could I just add one thing, just fill on Yasemin's comment? I think it's really important we to simplify things, sometimes talk about the opportunities around like innovation versus scale. That there's a certain, the people and impact investors are focused on innovation. They love doing things that are new. They love tinkering with models. They love setting up new structures. And they're like inventors. They feed off of that kind of creation and really exploring new opportunities. But then there's a lot more capital around kind of, the scale is around, people who want things that are tried and true, things that may be old fashioned, plain vanilla. We had to organize a panel at a conference with a CIO of a major European insurance company. They managed, I think, $200 billion in assets. And the way that he had talked about it, he's like, I like fifth time funds. Funds that have been around, and they've done 5 different versions of that fund. And he said, I know that's not exciting, I know that's not boring, but that's not my aspiration in life. I want stuff that is tried and true, and I think that is, understanding those different roles is so important. And if we are going to achieve that scale of the SDGs, it's not all about innovation, that's critically important. It's about taking the things that are proven at work and rolling them out all around the world so we can maximize the impact.
Great. So last question before we turn to questions from the viewers. And I'm gonna put this question to you, Amit, but then Yasemin, fair warning, I'm gonna ask for your insights as well. Over the past years, the impact investing world has often been described as being at a tipping point. But my question to you is, what does that tipping point look like? So Ronnie Cohen, for example, suggests that we'll get to a point where impact metrics will be common for every investment. Earlier in the JP Morgan reports, there was a suggestion that it's a tipping point if impact investing becomes an asset class. So what do you think the tipping point is where impact investing becomes the normal? And how close are we to it?
Yeah, and I think, just to focus on where our vision for where we end up for this is that the vision of the GIIN is that impact becomes part of all investing. Where any investor anywhere in the world just considers their impact alongside financial return and risk. So it's kind of just built into the system. It's just the way that we operate. We do have a long ways to go to get to that point, but I think we're actually in the midst of, whether it's a tipping point or one of these inflection points where there's a lot of what I hope is a very tectonic shift, where we're now seeing very traditional investors. I'll be speaking later this week with the CIO of a big pension fund that explicitly said publicly that we are looking for opportunities to put impact or to put investment capital to measurable strategies that have measurable progress towards impact goals. And it's, this is the type of thing that it's a mainstream institution, and they are, very actively shifting their model to think and very much centered on the SDGs. That to me is an incredible, sign, because they're not a kind of do-gooder institution. They are inherently trying to, they're a financial animal, but I think in very commercial in orientation. But this is now seen as a very comfortable thing for them to say out loud and to explore very publicly. So I think we're now at that, the snowball is packed and it's rolling down the hill, and it's important for us to make sure two things. One, that we do everything we can to help guide its growth and support it, but also we're very focused on scale with integrity. How do we build the great scale of capital, but make sure that we're actually scaling impact? And so a lot of our work at the GIIN is that, working on along those two dimensions, mobilizing big investors to really make sure that tipping point is happening, but also make sure we are scaling investment with a true focus on measurable positive impact.
And Yasemin, anything to add or different view?
I mean, maybe to complement what Amit said, I'm in the middle of recruiting, and the talent available today versus what we had available 10 years ago when I started out in this work is exceptional. And that comes from both the interest of a new generation of people entering the financial services industry, also the university system kind of offering courses around this. I'll be teaching at the University of Cape Town remotely next week. And I think that is, honestly, it has brought so much rigor and depth to the work that we're doing. I mean, Amit talked about the impact management kind of standardization project, for example. The degree of skill that's available today, there's a huge tipping point for me around talent. I will also say that I think with respect to the arrival of institutional investors and such, I think I struggle with the term tipping point because it feels very binary. To me, it's more like the waves come, like the tide is coming in. Mm-hmm. And the tide is coming in, you have waves crashing onto the shore, you have some current going back as well. I think some early movers might be looking at the sector today and wondering what they've achieved with the investments that they made 7 or 8 years ago. And that is a really important moment in time too. You need to be able to prove to yourself that you did achieve the dual purpose you were after. And so the impact management and measurement, like 7, 8 years into a private equity investment, is a crucial moment in time. So I think we need to be looking at investors all across that journey and that timeline. So yeah, I like the wave analogy.
Great. All right, well, thank you to both of you. Let's move to the Q&A portion. And I must say, we've got a lot of questions. I'm going to give the apologies ahead of time that we're probably not going to get to all of them. But let me start out with one to Amit. And this question is about the relative importance of harmonization and impact metrics during COVID. There's a question that says, should we continue to focus so much on impact metrics if those efforts would stand in the way of capital being quickly committed during the COVID crisis?
Yeah, I think I really appreciate where this question is coming from, right? And this prioritization around like speed or rigor, and do we want to kind of have any friction on the flow of capital? The way that I would think about it is that if it is truly capital that's responding to the COVID crisis, that we have, it's important that we make sure it is targeted in a way that will allow it to succeed in its intent of achieving an impact. But I would also say that where we are with metrics now is very different from where we were, even just a few years ago. With the launch of Iris Plus, we now have a system that is used by over 11,000 people around the world, and including major institutions and small boutique firms. And so that is a great starting place, and one that is we found to be very practical and pragmatic. One of the things about the way the GIIN works, as you can probably tell when with our network, is that we are a network of practitioners, investors who are deploying capital. We're not a think tank, and so everything that we do is very much responsive to the needs of investors who are waking up every day, putting capital to work, and trying to understand its impact. But I think the last thing I'd say on this question, which I think is really important, is that for capital to really flow at scale, we are actually hearing from the bigger mainstream institutions that they need sophisticated impact metrics. They need to know if they're doing a good job. They want data about it, and they also need the market to speak the same language. So having a whole bunch of firms, whether they're clients of CDC or other DFIs or private investment firms, all have their own metrics, makes it incomprehensible to anyone entering the space. Whereas where we're at now with a majority of investors using Iris Plus, that actually allows people to just start learning the language that everyone else is speaking, which actually has been important to facilitating the flow of capital. That would be my take on that, but I really appreciate where the question's coming from.
Great, thank you. And a question for you, Yasemin. There's a question about how have you been able to invest during the COVID crisis when field visits are probably impossible? How have you been able to do due diligence?
So that's a very important question. And we ran an exercise early on in the crisis to map out what remote due diligence would satisfy CDC's investment committee. So across all of the different areas we would normally investigate, including the investment due diligence, commercial, financial, operational, but also environmental and social questions, business integrity questions, and the development impact due diligence. How would we conduct this across the board? And so guidance was produced for deal teams. We asked each deal team to put in the back of their investment committee paper a specific write-up against the checklist of how due diligence was conducted on each of the questions. And then that was assessed by the IC. And because we have a multi-stage process, investment teams were able to come early on and say, here's our DD plan. Here's how we intend to get over these constraints that we have today. We're going to use these people in country, or we're going to do this remotely, or we have this third-party service provider. And so we were able to agree as an investment committee that we were comfortable with the process that was proposed. Then off the deal team went. I will say, we worked a lot with existing relationships, because trust building with the promoter or the leader of the business you want to invest in is, I think it's probably the most challenging area that we'll face. And as we kind of recognize that travel will probably be limited for a longer time than we originally anticipated, and we want to start bringing new relationships into our portfolio, that's probably going to be one of the biggest challenges that we'll have ahead of us.
Okay, Amit, one of the criticisms of the capital system is a focus on passive investment and short-term return seeking. Whereas one of the defining parts of impact investing is this notion of long-term sustainability. Have you seen any impact on the broader capital markets approach to this kind of passive short-term approach because of impact investing?
Yeah, I think, so I wouldn't say we've seen a direct impact that we could attribute to impact investing, but what we have seen is a lot of the larger asset management firms have become incredibly interested in sustainability and impact overall. And I think it hasn't, it's still early days for that journey, but we're now seeing actually a majority of the world's largest asset managers have users of Iris on their teams. And so we are really seeing a growing interest from bigger asset managers. we're not only thinking about this impact investing in private markets, but are also thinking about how they understand the positive and negative impacts of bigger companies throughout their entire portfolio. And that's the trend that I'd highlight the most, is that we are seeing kind of an interest in understanding the positive impacts of all investing, and in the medium term, hopefully a convergence of this thinking of how do we build portfolios that go from huge multinationals all the way down to small ventures, as well as the whole discussion on impact measurement and impact overall.
Right. And Yasemin, as we talk about encouraging more impact investment, we're generally talking about institutional investors, insurance companies in the United States and Europe. But should we be doing more to encourage local investors to become impact investors in our markets, our African markets and South Asian markets?
Absolutely. And I think the India Impact Investing Council is a great example of the power of that. That group has been putting a lot of thought together about the market that they're operating in, the tools that they can use in that market, crossing over between venture capital and different types of kind of fund profiles. And to me, that is a fantastic global leadership that we can all be learning from. So, I would welcome that kind of engagement from lots of different places. I think our funds team has actually been working with local pension fund managers in Africa to try and encourage and teach some of our methods there as well.
Yeah, I think, just very briefly, I think it's really important because there is this, in many emerging markets, there's a north to south flow of capital when it comes to impact investing. But we are also seeing kind of, some really emergent signs of a local kind of LP-based and investor-based developing in places like India. One of my last trips before we all shut down was to Brazil, and there's actually a lot of interest from Brazilian family offices and some institutional investors in impact investing. So I think that's starting to happen, and it's important for organizations like the GIIN to really support that growth. And that's part of why a global network can help draw those connections and do some of that education work.
Great. And last question, Amit, and this one has to do with impact and risk. And there's a question which is asking whether the GIIN framework permits people to think in terms of risk rather than just of impact. So this notion of what's the likelihood of having a positive impact and what is equally the risk of having a negative impact, and how an impact investment might have some negative impact, and how you handle those both sides of the equation.
Yeah, I really appreciate the question, because I think this is this is the type of thinking and work that we need to do as a sector. What I'd say that, so in Iris Plus, a lot of our focus has been on getting people to measure the metrics that matter, and also to start sharing more data so we can conduct impact performance analysis. And we actually have next month we'll be issuing 2 reports that are looking at impact performance analysis in agriculture as well as in financial inclusion. And what that then allows, as we start to track more data and understand impact performance better, is understanding the relationship to some of these other dimensions. So one is risk, and the relationship between impact performance and risk. And as you point out, what is what's your risk of achieving that impact and the likelihood. And the other thing that I think is important is understanding the relationship between impact performance and financial performance. If I can add to the question of another dimension that we're starting to explore more. So I think it's still early days, because we are really just in the, I think, a very exciting phase of deepening our understanding of impact performance itself. But then the next frontier is the integration of impact performance, financial return, and risk, which is really where we see our work at the GIIN going from a research and market leadership standpoint.
Amit, can you remember back in 2010 when we wrote the definition of impact investment for the very first time, we had a discussion about whether it should say net positive.
Yeah.
And we decided it was very important that it was considered net positive, but we also thought if we went out with that level of technical detail for a very nascent market, it was going to confuse too many people. And so we kept it simple and called it positive. But even 10 years ago, we were already thinking like that.
Yeah. No, that's right. And I think many impact investors that started with a very targeted focus, like we're trying to promote sustainable agriculture in, let's say, East Africa, or we're trying to work on gender equity issues in South Asia, are now broadening, you know, as they get like more sophisticated about understanding their impact. It just begs the question about, are we understanding our other positive impacts and our negative impacts? And so I think many investors are at different stages of that journey to having a more holistic view of the impact that they're having.
Okay, well, thank you very much, Amit. Thank you very much, Yasemin. Let me try and briefly summarize, I guess, what I've learned today, which is, I mean, impact investing has certainly come a long way in the past 10 years. But it's not just about the amounts, which have increased extraordinarily, but it's also about the way that we're doing impact investing, in the complexity. And Yasemin shared with us some new and innovative approaches to doing impact investing, especially at CDC. And Amit shared with us some thoughts about the emerging notions of what impact is, harmonizing metrics, also this notion of balancing risks and so forth. COVID has been a challenge in impact investing, as in many sectors, but it seems that it may also be the driver of positive change. So I would sum it up by saying that we have a lot of work ahead of us, much to work for, but I feel that we can leave today with much also to hope for. So once more, I'm afraid, Amit and Yasemin, you can't have the benefit of a resounding round of applause, but my thanks to you, my thanks to all who joined us today.
Thank you so much.
Thank you very much, everyone.